Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Brent crude surges 5% as US sanctions target Russia's oil giants Rosneft and Lukoil, threatening global supply. So we'll discuss why this direct strike on Russia's energy revenue is a major policy shift and what it means for global oil markets and geopolitical stability. Second, US single-family rent growth plummets to a 15-year low, offering a critical leading indicator for the Fed's future rate cut decisions. We'll explore how this rental market slowdown, driven by a construction boom, could ease official inflation and reshape the Federal Reserve's timeline for interest rate cuts. Third, Tesla's 37% profit plunge and a wider tech sell-off reveal the market's mega cap concentration risk ahead of critical earnings. Today, we'll take a closer look at the conflict between Tesla's costly AI gamble and a brutal price war and its implications for the fragile tech-led market rally. Let's start with a decision that caught everyone by surprise. The United States has just dropped what the US president is calling tremendous sanctions on Russia's two largest oil companies, Rosneft and Lukoil. This is a bombshell move. These two giants account for nearly half of Russia's entire crude oil exports, or 3.1 million barrels per day. This is the first time the Trump administration has directly targeted Russia's energy sector over the war in Ukraine, a major reversal of policy. The immediate market reaction was a 5% surge in Brent crude oil prices. A while back, we analysed how Moscow kept sales going through a shadow fleet and other workarounds. What's new is that Washington is no longer nibbling at the edges of logistics. It's going straight at the revenue core with Rosneft and Lukoil. And remember, after that lengthy Trump-Putin call, we mentioned potential in-person talks in Hungary. Well, the president now says those conversations went nowhere, hence the pivot. So that 5% jump, it's what the market calls a fear premium, an initial speculative reaction. The key question now is whether this is a temporary blip or the start of a structural supply crisis. The answer really depends on the next steps. If these sanctions don't genuinely stop the oil from flowing, prices could settle back down. But if the US follows through aggressively, we could see a real sustained supply reduction, and that would put serious upward pressure on global inflation. Why the sudden shift? According to the US president, his direct talks with Vladimir Putin were going nowhere. In his words, every time I speak to Vladimir, I have good conversations and then they don't go anywhere. I just felt it was time. A while back, we walked through this transactional streak. Let both claim victory. Let history decide. And today's move fits that pattern. Abrupt, personal, and market moving. This abrupt move, after attempts at personal diplomacy, is significant because it signals a highly personalized and unpredictable US foreign policy. And here's an overlooked consequence. This deal-making approach to sanctions, where policy seems to shift based on executive whim rather than a long institutional process, increases what's called geopolitical risk. For investors, this makes long-term decisions much more complicated, and we often see this reflected in a higher VIX, the market's fear gauge. We previously noted how the same unpredictability even spilled into defense policy debates, like the talk of denying long-range missiles, shaking the higher for longer, defense spending narrative. Different instrument today, same policy volatility. The US Treasury Secretary was even more blunt, stating the sanctions target the corporations that help fund the Kremlin's war machine. And Rosneft alone accounts for a staggering 6% of total global oil output. Here's where it gets interesting, the global ripple effect. This move puts Russia's biggest customers, China and India, directly in the crosshairs. Last year, China bought a record 100 million tons of Russian crude. Since 2022, India's purchases have ballooned to some $140 billion. For a Chinese-speaking audience, the likely strategy here is not direct defiance. Instead, China will probably prioritize its energy security by shifting purchases to smaller, independent teapot refiners who are less exposed to the US financial system. At the same time, we'll likely see an accelerated use of non-dollar payment systems, like China's own cross-border interbank payment system, or CIPS. This highlights the limits of US sanctions and could speed up the creation of a parallel financial infrastructure for trading global commodities, slowly eroding the US dollar's dominance. As we flagged a while back, serious enforcement risks a broader confrontation with Beijing and could add volatility to the RMB, another incentive to route flows through smaller players and non-dollar rails. The big question now is whether the US will threaten secondary sanctions on the international banks and refineries that keep that oil flowing. Quick refresher from an earlier episode, secondary sanctions are when the US penalizes third-party countries or companies, say a bank in China or a refiner in India, for doing business with a sanctioned entity. This is the real test of America's financial dominance. The key indicator to watch is the price spread between Russia's Urals crude and the global Brent benchmark. If that discount widens, it means buyers are scared off. Recent data already shows that spread widening slightly, and shipping data reveals a 15% decline in Russian oil shipments to India and China over the past month. It's all adding up to a real-time stress test. Indian state refiners are already reviewing their trade documents to avoid direct dealings. Recall the public back and forth a while back when Trump said Prime Minister Modi would sharply cut Russian oil purchases, and New Delhi didn't confirm today's behaviour. Looks less like a headline pledge and more like quiet, compliance, risk management. And as we discussed previously, Washington's tariff playbook penalties as high as 50% on Russian oil has already shown it can bite and rattle trade flows, a signal that enforcement pressure could escalate from here. This isn't just a political statement, it's a direct strike at the revenue funding Russia's war, with taxes from oil and gas accounting for a quarter of the nation's federal budget. As analysts note, Russia will now face difficult trade-offs between maintaining socio-economic stability and financing a protracted war. It's the same question we raised a while back. How does Russia sustain the war without oil cash, now being tested more directly? And the culmination of all this is the sheer fiscal pressure it creates. Recent data from Russia's own finance ministry showed oil and gas revenues fell by over 30% year on year, hitting their lowest level in over a year. This revenue collapse forces the Kremlin into a politically dangerous corner. Does it cut social spending and subsidies for its own people, or does it scale back funding for the war? A choice like that could test the government's social contract and its ability to sustain a long-term conflict. The focal point to watch going forward will be Russia's monthly budget revenue reports and any signs of a ruble devaluation. Speaking of economic pressures, let's bring it back home to the US market, where a major cooldown is happening in a sector that affects almost everyone. It seems the party might be over for landlords. Rent growth for single-family homes just slammed on the brakes, hitting a 15-year low. The annual increase was a mere 1.4% in August, a shadow of the 3% average gain seen just last year. And this isn't just a housing story, it's a major signal for the entire US economy and the Federal Reserve. You see, the rent you see advertised online, what economists call market rent, is a leading indicator. It tells us where official inflation is headed. The government's Consumer Price Index, or CPI, which the Fed watches closely, measures shelter costs differently. It includes both new and existing leases, so it moves much more slowly. Research from the Federal Reserve shows there's about a 12-month lag. So the sharp slowdown in market rents we're seeing today strongly suggests that the official shelter inflation, which makes up over a third of the entire CP, will fall significantly in the coming year. This is the key to solving the Fed's last-mile inflation problem and could open the door to earlier interest rate cuts. This isn't an isolated event. The entire rental market is cooling down, and the reason is a massive construction boom. A flood of new multifamily units has hit the market, pushing the national vacancy rate to a record high of 7.1%. Now, get this. This construction boom is particularly concentrated. We're talking about an unprecedented surge in apartment completions, especially in Sunbelt cities like Dallas. This is creating a localized supply shock. The situation presents a fascinating duality. On one side, it's great news for renters in those areas, while on the other, it could create real distress for property investors and expose vulnerabilities for the regional banks that finance these projects. With more empty apartments than ever, landlords are losing their pricing power. Nationally, apartment rents are actually down 0.8% from a year ago. But before renters start celebrating, there's a reality check. The national median rent today is still 22% higher than it was in January 2021. That cooldown came after a period of unprecedented, record-setting rent growth. While the typical rent is about $48 a month cheaper than its recent peak, it's a small drop in a very large bucket. Interestingly enough, this slowdown is hitting different parts of the market unevenly. The deceleration in rent growth is actually much sharper for lower priced properties. This isn't just about supply, though. It's a sign of demand side weakness. It suggests that many lower income households have exhausted their pandemic era savings and are now under significant financial strain. We're seeing this confirmed in other data, like rising credit card delinquency rates for this same group. They simply can no longer afford the high rents, forcing landlords at the lower end of the market to cut prices more aggressively. This sets up a core conflict. A historic wave of new supply is forcing a market correction, but it's happening after prices have already soared to historic highs. You can see it in the regional data. While Dallas is seeing rents fall, cities like Chicago and Los Angeles are still posting gains. The result is a two-tiered rental market. The divergence reflects a structural shift in preferences since the pandemic. Many people still want more space, which keeps demand for single-family homes strong, and the supply of those is very limited. This is why single-family rents, while slowing, are still growing faster than apartment rents. It complicates the national affordability picture. So, what should we watch for next? The most important thing is the official CPI shelter data in the months ahead. We need to see if this dramatic cooling in market rents actually translates into the government's inflation numbers. If it does, it would give the Federal Reserve the green light to consider easing monetary policy, which could lower interest rates and be a positive catalyst for both the stock and bond markets. If the lag proves longer or the effect is weaker than expected, the Fed's inflation fight will drag on. The takeaway is a market at war with itself. A record-setting building spree is finally providing some relief, but for millions of renters, the financial damage from the last few years is already done. The slowdown is real, but the sticker shock remains, with prices holding at levels 22% higher than just a few years ago. We were just talking about a cooling rental market that could give the Fed some breathing room, but in the tech sector, the heat is being turned up and not in a good way. Tesla just reported a 12% jump in revenue, but its profit didn't just fall, it cratered. Net income at the electric vehicle giant plunged a staggering 37%. The reason? A perfect storm of bad news. The company is slashing vehicle prices to compete with a wave of Chinese manufacturers, while at the same time, its operating expenses exploded by 50%, fueled by massive spending on AI and other R&D projects. This is where the situation takes a more complex turn. Tesla is pouring money into what's called physical AI. Think of its Optimus robot and its own Dojo supercomputer. It's a pivot away from near-term EV profitability to try and build a vertically integrated AI hardware empire. The key here is that Tesla is trying to challenge NVIDIA's dominance and create a new model for AI investment that goes beyond just cloud and software. The success or failure of this bet could redefine the entire AI landscape for years to come. And as we noted a while back, the expanding definition of critical software in export controls adds another layer of uncertainty to any vertically integrated AI hardware push. And about those price cuts, this is bigger than just Tesla. The intense competition from Chinese EV makers forcing Tesla to slash prices might be a leading indicator of a much broader, more aggressive phase of global durable goods deflation. Now, a fall in the price of imported goods, especially from China, could actually help the Federal Reserve in its fight against inflation. But here's the double-edged sword. It also signals a major threat to the profitability and even the employment of Western manufacturing companies. So this price war in the EV space is a signal we need to watch very closely. As we've discussed before around the risk of a hard decoupling, if trade and tech restrictions tighten further, that could collide with this deflationary impulse in messy ways. Investors reacted instantly, sending the stock down in after hours, trading very much in line with the fast repricing we talked about a few days ago when asymmetric shocks hit crowded trades. But that's not the whole picture. Tesla's bombshell report landed just one day after disappointing earnings from Netflix sent its stock sinking 10%, and a weak report from Texas Instruments caused a 5.6% drop. This trifecta of tech trouble was enough to drag down the entire market, flipping both the S&P 500 and the Nasdaq into negative territory for the month of October. We previously analysed how a stumble in one corner of tech rarely stays contained because of how the indices are built today, was another example. What this really does is expose the market's hidden vulnerability. This is a classic example of mega cap earnings concentration risk. As we've discussed before, the market has become incredibly dependent on a handful of giant companies. Right now, the top 5 stocks in the S&P 500 companies like Apple, Microsoft, and Amazon make up about 25% of the entire index's value. This makes the whole market fragile. A miss from just one or two of these giants can trigger a broad sell-off, as we just saw. So what's next? This concentration risk makes the upcoming earnings reports from Apple and Microsoft a critical stress test for the entire market. If these remaining behemoths also disappoint, we could see a very rapid market correction. Therefore, these upcoming reports will be a key focal point for judging whether the current market rally has real strength or is built on a fragile foundation. But the pain isn't just in stocks. A brutal crypto wipeout just erased $19.37 billion from more than 1.6 million traders in a single 24-hour period. While Bitcoin took a hit, the real devastation was in smaller tokens. Lesser-known coins like XRP, Solana, and Dogecoin are trading between 15 and 24% below their pre-liquidation prices. As we noted a while back, when positioning is crowded and liquidity thins, shocks can cascade quickly. From electric vehicles to streaming and digital currencies, this wave of earnings misses and extreme liquidations is sending a clear signal across the board. The market is aggressively punishing any sign of weakness, and no sector appears to be immune. This content is for informational purposes only and does not constitute financial or investment advice. All investments involve risk, and past performance is not indicative of future results.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.